Hi, I'm Jared Nelson from the Investing Channel, and welcome to Markets in Minds, the show where we break down big macro themes into simplified trade ideas. One of the things that traders have to come to terms with is the separation of the economy from the market. Two things which on the face of it seem intertwined. However, the truth is that though they are linked, they are not one and the same. In theory at least, it's possible for one to exist without the other. For example, there was an economy in the Soviet Union that existed without a financial marketplace. And with the emergence of crypto and digital assets, there are now markets and instruments that exist independently of any or perhaps all economies. Those examples are two extremes, of course, and in most other cases, there is a relationship between an underlying economy and the financial markets within it. What traders and investors need to do is to understand that relationship and how the two structures interact. Most of the time, the economy, or expectations about the economy, will tend to drive the markets, though it is possible for feedback to flow the other way around. For example, if interest rates and inflation are thought likely to rise dramatically in the future, then that could mean businesses hold off on investment or expansion, which in turn could slow the rate of economic growth. Conversely, a booming stock market can create positive economic sentiment, which in turn can make businesses more confident about investing, which can promote economic growth. What often confuses investors and traders about these circular relationships and information flows is timing. And here we need to consider two things. Firstly, what kind of data comes out of the economy, and secondly, how markets are influenced by and use that information. In essence, there are two types of economic information, which are known as lagging and leading indicators. Lagging indicators are backward-looking data. They tell us what has already happened, but not what is likely to happen in the future. Examples of lagging indicators are the unemployment rate and GDP, which report data a month or even a quarter in arrears. Leading indicators, on the other hand, are forward-looking and are predictive of future events. Examples of leading indicators are the ISM and PMI surveys, which try to anticipate spending, employment, and investment intentions among businesses a month or more in advance. In a parallel to the world of quantum mechanics, there is trade-off or uncertainty between lagging and leading indicators. And that the more forward-looking an indicator is, the less accurate its predictive power is likely to be. Whilst the further an indicator lags behind, the more accurate the data it contains will be, but the less useful it becomes. Financial markets try to manage these paradoxes through a mechanism called discounting, in which they try to model current data and price it into future or anticipated events. This is the reason that markets are said to be forward-looking. For example, prices in stock markets now are reflecting expectations about earnings and returns 6, 9, or even 12 months ahead. Whilst bond markets are constantly pricing events 10, 20, 30, or even 100 years into the future. The way that these prices vary over these time frames creates the yield curve, or the cost of money out into the future. All of which means that traders need to work out what information is priced into the market and what isn't. For example, if we have a large swing in the unemployment data, has that been priced in or anticipated by the markets? Or does it represent new information with the power to move prices? To some extent, traders can do this by comparing the data against the consensus forecast of Wall Street analysts for that data. The larger the surprise in economic data compared to analysts' forecasts, the greater the potential for price changes within financial markets will be. In recent years, Citigroup has even created a series of economic surprise indices to track the levels of surprise contained with key data releases. This chart plots those surprise indices for the G10 economies against those of emerging markets. Taking all this into account, the trader or investor needs to work out at what point in the economic cycle they should be buying the markets and at what point they should be selling. The temptation is to think that you should sell on the downturns, jumping out of the stock market when the prospects for the economy look bleakest. However, market orthodoxy and recent academic studies suggest that the opposite is in fact true. In a paper published in December last year, academics from the Montpellier Business School and Poznan's University of Economics and Business found an inverse relationship between the so-called misery index, a combination of the rates of inflation and unemployment and future stock market returns. The study examined almost 60 years' worth of data from 65 stock markets spread across 23 developed and 42 emerging economies. The upshot was that those countries which had the highest misery index readings typically had the best performing stock markets, as investors and traders anticipated better times ahead and put money into the market. What's more, the smaller and less developed an economy was, then the bigger the returns from its stock market were likely to be when its economic circumstances were at a low ebb. Learning to think and act like a trader, that is, with a contrarian mindset, is one of the toughest things for retail investors to master. But if they can do it, then they're definitely giving themselves a trading edge, which is all a trader can ever really ask for. That's all we have time for this week. Make sure you do your own due diligence before making any investment decisions.